Hi, I'm Stan, the Annuity Man, America's annuity agent licensed in all 50 states, including yours. Glad you joined me. This is the fixed indexed annuity series that I'm doing on this specific product type because there's a lot of hype out there, there's a lot of misinformation, a lot of high pressure that's going on, and I want to break it down. So in this specific video, we're going to go over how that index option is calculated, spreads, caps, participation rates. It's going to be a little choppy. We're going to go slow. I'm going to put some of the numbers right here beside me so that you fully understand it. But at the end of the day, you need to do two things before you buy an index annuity. Obviously, you need to watch the video. But the other two things is get my book on indexed annuities, fixed index annuity owner's manual. Go to theannuityman.com. I'll send you that for free and under no obligation. The second thing you need to do is you need to set an appointment at theannuityman.com to speak with me one-on-one. Yeah, this is a big phone, but I'm driving a point home. We need to talk. It's not going to be a sales pitch. It's going to be a one-on-one conversation about how these products work and to determine if you even need one, to actually bring you down to reality from the standpoint of the things that you've heard, have been told, and been pitched, read, seen on a TV ad, or heard on a radio show. I'm going to tell you the truth about these products, how they can and cannot fit in your portfolio, but we can't do that until we hear music. All right, here's an overview on how indexed annuities are calculated. To calculate interest, that accumulation value on indexed annuities, fixed index annuities, the annuity companies calculate where that index that they're using starts and then where it finishes during that duration. Now, typically, most annuity companies have a 1-year call option duration, but some have 2-year, 3-year, 4-year, but the vast majority are 1 year. So they're looking at a snapshot of where the index started and then where it finished. So here's how it works. Ending value minus the beginning value divided by the beginning value gives you that interest rate credited. Follow me? So here's an example. The index starts at 1,000, and at the end of the contract anniversary date, it ends at 1,050. Here's how it continues to work. The 1,050 minus the 1,000 equals 50 divided by 1,000. Please, I know this is confusing, but hang in there with me. But this is the reason we need to talk. So that it equals 0.05, or in this case, 5%. All right, so that's the basic. That's the basic calculation. Now, from that basic calculation, then the levers are applied by the annuity company. What are the levers? Caps, spreads, and participation rates. So when you're buying that indexed annuity, you need to understand what levers they're using, caps, spreads, participation rates, or combination of those, and what those minimums are. Once again, that's stuff that we need to talk about. Oh, and this is kind of throwing a little wrench into it. These levers that I'm talking to you about, getting ready to explain, the caps and spreads and participation rates, those can change at the discretion of the annuity company that issues the policy without them talking to me or you. So there could be a very high percentage on these cap, spreads, participation rates, kind of as a teaser rate to get you into the policy, but then they can change that on that contract anniversary date. Again, most of them are 1 year in length. The example I gave you above where I was, subtracting and dividing, that was assuming there was 100% participation rate. Let's do an assumption that the participation rate was 85% of that example. Under that scenario, the return would be 4.25%. So how did I get to that? Is 5 times 85% equals 4.25. So let's look at caps, and let's just assume that the maximum credited rate is capped. In the example above, if the maximum cap is 6, your interest rate credit would be 5%. And again, if your cap is 4%, your interest rate credit would be 4%. All right, so we've talked about participation rates and caps. Let's talk about spreads. Now, fixed indexed annuities, if you do not attach an income rider to them, there's no annual fees. Now, the interesting part about spreads is some companies call spreads a fee, but it's really not a fee. It's actually a margin. It's a certain amount that is taken away from that interest credited. In the example above, if the spread is 1, then the interest rate credited would be 4%. Oh, by the way, a spread can bring your interest rate credit down to zero, meaning you're not going to get any return for that year, but it's never going to produce a negative return. I mean, the worst you can do with an index annuity is zero. Some agents say zero is your hero. I hate that. But once again, we went through spreads and caps, participation rates, and that's just the basic premise of them, trying to kind of get it to a level where you can understand it. But as you know by now, you're going to have to talk with me to find out the exacts of these products, the specifics of these products, so you can make a good decision. All right, currently at the time of this taping, there's 700 different index option strategies out there, which are the combinations of all the caps and the spreads and the participation rates, etc. And there's over 40 plus indices that are being used. Some of them created out of midair, meaning that the companies look for return back testing and create an index name out of thin air and then say, well, if you'd owned it 10 years ago, you'd have made this return, even though it hadn't existed. And a lot of states are cracking down on that. But you know, the strategies that are out there are numerous, and not one is really better than the other, in my opinion. Once again, we have to go back to the premise of fixed index annuities. What do? They're CD products, they're fixed annuity products, they're issued by life insurance companies and regulated at the state level. They are not securities. All right, so let's go over some of the strategies. Let's talk about annual point-to-point, long-term point-to-point, and let's also talk about monthly or daily averaging. Annual point-to-point is pretty basic. I don't want to get in the weeds of this, but in essence, the contract anniversary date this year is your starting point, and then what it ends up at the contract anniversary date the next year, that will be your starting point for the following year. Okay, long-term point-to-point, like I said, most of the index annuities calculate on an annual basis, but there are some longer-term point-to-points, meaning maybe 2 years or 3 years or 5 years, 4 or 5 years. Regardless, you need to understand that. Obviously, I need to explain that to you and the benefits of them. But in essence, instead of doing from this year to next year, if it's a 2 years, this year, and then to the contract anniversary date 2 years from now, or if it's 5 years, contract anniversary date now to contract anniversary date 5 years from now. All right, let's talk about monthly and daily averaging. Instead of the company going from contract anniversary date to contract anniversary date, the company uses an average value. So with the monthly average, the index value is tracked on the same date every month for that time period it's tracked. Then those numbers are added up over that 1 year contract term, contract anniversary date to contract anniversary date. They're added up and then divided by 12. So after you divide it by 12, you come up with the average N number. For the daily average, the company looks at the index daily. They track it and then they divide it by 365. That comes up with the daily average N number. Your new beginning number will be the actual index number on that contract anniversary date. I know we just did daily. You're going, oh, Stan, you're killing me. That's the reason you need to talk to me. So let's talk about monthly sum and monthly cap. This method calculates and tracks the interest on a month-to-month basis. It looks at both increases and decreases. Here's where you need to pay attention. The increases are capped. The decreases are not. That's key. At the end of the anniversary, they add up both increases and decreases. And if the total is positive, they credit that interest to you. In my opinion, this is the one that's most incorrectly sold and hyped, because what people will do is they'll say, okay, here's the monthly sum, the monthly credited, and you can get up to 3% each month for 12 months. So, you know, the typical agent at the Bad Chicken Dinner Seminar says, hey, 3 times 12 is 36, so your cap is 36% on the upside. That's such a misleading presentation, I can't tell you, because markets don't work like that. Now, if it's capped at 3%, or 2% or 1%, whatever it is, remember, there's no cap on the downside. So let's just say we go through a down period of a minus 1 month with just something went wrong, and it's minus 10, it's minus 10. You get all of the downside on that. There's no cap on the downside, but there's a cap on the upside. So which method is best? No good answer there. It just depends on how the market acts. In a steady, like going up market where it's just going up, monthly sum is probably going to win. In an up and down market, like choppy, the averaging is probably going to win. And for the annual or long-term point-to-point, all that really matters is that Where you end, that ending contract anniversary date, whether it's 1 year, 2 year, 5 years, is higher than where you began. Anything that happens in between that is irrelevant. I know that was a lot. I just threw a lot at you. I just vomited on you. I apologize for that, but boy, does that not give you a reason that we need to probably talk. And you shouldn't just buy an indexed annuity based on the sales pitch. There's a lot to it. There's no perfect answers, just bad sales pitches. But at the end of the day, it's a CD product. It's a good product. It's not too good to be true, but it's pretty darn good if you fully understand it. So click the subscribe button and make sure to watch my full series on this indexed annuity sales pitch stuff that's going out there. It's my fixed indexed annuity series that hopefully will make you well informed and you can make a good decision on your terms and on your time frame. I'll see you on the next Stan the Annuity Man video.